And welcome to our first quarterly investor call of 2023, and thank you for joining us today. This call is being recorded and will be available for replay by visiting our website, clicking on the Resources tab, and then clicking on Quarterly Investor Call. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or YouTube channel to view the recording of this call or any previous calls.
Thank you, Carly, and good afternoon. Thank you for joining us today. We're greeting 2023 with hopes for a less drama-filled year, and today I'll be sharing some comments about the roller coaster ride of the economy and markets over the last 3 years. And then we'll transition into our timeless principles that we always reinforce at the beginning of each new year, both on this call and in our quarterly newsletter. You'll probably notice that my comments today are brief, and we are decidedly not interested in trying to predict or forecast the markets or economy on these calls. When I'm done with my remarks, Dom is going to share some of our investment insights on 2 of our portfolio holdings, Capstone Copper, which is a long-term position that we haven't covered on one of these calls before, and BGC, which is a new purchase that we made at the end of 2022. So almost exactly 1 month from today, in February 2020, will mark the 3-year anniversary of when our entire world began shutting down. No living person on our planet had experienced this type of a global event simply because it hadn't happened in over a century, and no one could have anticipated the resulting economic impact that this would have on all of our lives. Here in the United States, the US economy declined 19% in 3 months, and the mainstream equity market saw prices decline by 1/3 in just 1 month. And then, without missing a beat, the Federal Reserve rolled out the most aggressive monetary stimulus we've ever seen to essentially put our economy on life support. The money supply of the United States increased by nearly $6 trillion in just under 2 years. And that stimulus worked, and it worked really fast. In just 6 months, the stock market decline was completely erased. And then over the next 18 months, it climbed to even greater heights than we'd ever seen before. But the economic reality of all this printing and money printing, it had to set in at some point. And in late 2021, inflation exploded. And the Federal Reserve and central banks, they had been trying desperately to keep our inflation at 2% for over a decade, as you can see on this chart that I have on the screen. And then we get to late 2021, and it spikes almost instantly to 8%. It's reflecting back on our April 2022 newsletter. We had talked about how many things behaved like a pendulum, and monetary policy is clearly one of those things. And this past year proved to be a clear example of this pendulum action, this behavior in action. The Fed response to inflation, which was caused by their massive monetary stimulus, their response was to increase interest rates aggressively, to slow down borrowing and spending, and then the pendulum swung in the other direction, and they raised those rates. It triggered a sell-off in the equity markets, which caused a bear market in 2022. So the storyline here again, from the beginning of 2020 to the end of 2022, we have a bear market set on by the pandemic, a recovery and subsequent advance to new heights in the market, and then another bear market, all within 36 months. All I'm doing is acknowledging that this has been a wild ride, and right now there is no compelling evidence that this chaos is over. Which brings me to my real lesson for today, is that there is no prediction for what is going to happen in 2023. The most reliable way to capture the full return of your equity investments continues to be to ride out this frequent but historically always temporary decline that we see in the market. If you noticed on the last slide, despite the 3-year roller coaster ride we've all endured, the mainstream equity market managed to close out 2022 about 18% higher than it did at the end of 2019. So this is by no means an especially exciting result over a 3-year period, but it's very much still in positive territory. And I want to remind you that we are not investing in the macro economy. The portfolios that we manage, they primarily consist of ownership interests in enduringly successful companies. These are businesses that even today continue to make refinements and adjust their strategies to meet all the opportunities in our world today. And so my call to action is just to continue this path forward. When we meet to review your plan, our objective is to answer the question, are we on track to hit your retirement goals and your other objectives? And then we ask, do we need to make any adjustments to our plans to ensure that they're long-term successful? So the tactics, the strategies, and the behaviors that support your plans, that's what we can influence, the things we can control. We're not trying to time the markets or predict events or policy changes. We're measuring the returns you need and then building an investment strategy that historically outperforms those needs. In that sense, it's very simple, but it does require maintenance, and most importantly, requires your faith in our future. The world is going to continue to make its long-term trend of improvements. There's over 8 billion people in the world today, and there's hundreds of companies that are trying to make the world a better place for these people. There's no guarantee this year will be better than last year, but if you keep a long-term perspective, the future looks brighter than ever. We're looking forward to our annual reviews of your plans, and we'll be in touch throughout the year to make sure that we continue on this path forward. With that, I'm going to turn it over to Dom to give you some portfolio updates.
One of the positions that we held for several years is Capstone Copper. We made our initial purchase in 2015 when the stock was trading for just pennies. During that year, Capstone generated around $420 million in revenue and operated at a loss. The company has undergone drastic changes, which I wanted to highlight today, as Capstone is not a position we've highlighted recently. Capstone is a copper mining company. In 2015, the company operated 3 mines, Pinto Valley in Arizona, Cozamin Mine in Mexico, and Minto Mine in Canada. The company operates Pinto Valley and Cozamin still, but sold the Canadian mine in 2019 for $20 million. Since 1975, Pinto Valley has produced more than 4 billion pounds of copper. Capstone acquired Pinto Valley from BHP in October of 2013. And in 2015, Pinto Valley produced over 120 million pounds of copper, and it cost them about $1.97 to produce 1 pound at the time. In 2021, Pinto Valley produced around 133 million pounds at a cost of $2.16 per pound. Typically, the cost to extract a pound of copper increases as the mine gets older, as the easy copper is mined first, which is also the cheapest, and the further you dig, the more expensive it is to extract. The 133 million pounds of copper translated into $547 million in revenue and generated $281 million in pre-tax income. This is a dramatic improvement from the 2015 results, where the mine generated $261 million in revenue and $50 million in pre-tax income. Higher revenue and higher profits were driven by the price of copper increasing from $2.35 in 2015 to roughly $4.42 in 2021. The increased price and revenue have little associated increased costs outside of the royalties the company pays. The price of copper has come down throughout the year and stands just above $4 per pound, which will continue to make this mine very profitable. Cozamin is a much smaller mine, producing just 31 million pounds in 2015 and 53.8 million pounds in 2021. However, the economics and profitability of the mine are much better, as it costs 96 cents to mine 1 pound of copper. This is one of the key features we look for in any commodity producing company. How much does it cost them to produce their product? The lower the cost, the greater their ability to weather a down pricing market. This is one of the main reasons we like Capstone relative to other copper producers. Capstone is one of the lowest cost copper producers in the industry, and we continue to like them for this reason. Moving on to the changes that occurred, Capstone underwent a significant merger at the end of 2021, combining the existing Capstone mining assets with Mantos Copper, forming the new company Capstone Copper. The newly combined company increased Capstone's annual production from 187 million pounds to 350 million pounds, almost a doubling. On top of this, Mantos Copper was expanding an existing mine that is set to finish in 2024, which will add about 140 million pounds of copper. Finally, Capstone is developing a low-cost mine, Santo Domingo. This mine will have an annual production of roughly 240 million pounds of copper and should come online in 2025 to 2026. To recap the transformation, Capstone by itself produced 187 million pounds of copper in 2021, and in 2026 to 2027, when all mines are expected to come online, annual production is expected to be around 730 million pounds. This is almost a 300% increase in just 6 years. If we are correct, and the green energy transition will use more copper, and limited supply comes online due to the regulatory hurdles, permitting, and expertise needed to open a new mine, the new Capstone Copper is one of, if not the best ways to play this idea. When a supply-demand imbalance occurs, prices go up, also known as inflation. With the inability for new supply to come online and increased demand for copper in all things green energy, copper prices should remain high for years to come. We are still in the very early stages of this thesis playing out and believe Capstone is well positioned to benefit. Turning to BGC Partners, which is set to benefit from the rise in interest rates and increased uncertainty in today's market. As you may have read, the Fed has increased rates at the fastest rate in its history. Most recently, raising rates another 50 basis points or 0.5% in December. BGC is a broker, acting as a middleman for complex financial transactions. Think of them like a real estate broker. The real estate broker brings in buyers and sellers of homes together, negotiates on behalf of clients, and once the transaction closes, they take a fee based on the size of that house. BGC does this, except instead of a house, they are involved in fixed income, interest rate agreements, foreign exchange transactions, commodities, and other obscure or complex financial products. Just like the real estate broker never takes ownership of the house, BGC does not take ownership of the securities. Thus, they should have no risk should an asset have a sudden and significant decline in value. In the early part of the 2000s, trading of securities between buyers and sellers was done by a human. You send an order in, and the trader, located in one of the pits of the exchange, would find a counterparty to transact with. If you ever watched an old Wall Street movie where you see people yelling at each other on the floor of an exchange, this is what I'm referring to. However, technology advances, and trading has gone electronic. where electronic exchanges constantly display quotes and you can transact instantly. This shift from a human element to electronic, while advanced for the trading of stocks and some bonds, is still in the very early years of electronic-based trading for the product's BGC brokers. BGC's legacy business model is still dominated by this old school human interaction, where a financial institution or corporation would call up BGC looking to buy a product. In this case, we'll say a fund wants to bet $50 million on the direction of interest rates. Maybe the fund thinks that the Fed will raise rates more than the market anticipates and wants to place a bet on this. BGC would go out and call many investment banks to get a quote for the trade. They would negotiate the price and fees the bank would charge and return to the fund with several quotes. The fund manager would then say which quote they would like to move forward with. BGC would call the investment bank back, saying they have a deal, and then they would ensure the transaction cleared. As you could see, this could be a time-consuming endeavor and is very labor-intensive. What if instead of having a person call around, an exchange would constantly quote the price at which investment banks are willing to buy or sell specific securities, eliminating the human aspect of trading? Enter BGC's Phoenix platform, which does just that. Costs come out as you don't need the human broker, and the ease of transaction likely increases the number of trades. Instead of waiting an hour or two to get a quote back, you can now trade instantly. The more trading that happens, the more money BGC makes. BGC's largest business is its rates segment, where hedge funds and corporations bet on the direction interest rates may move or hedge and lock in the interest rate they may pay if they're a corporation. When interest rates are at 0% and volatility, which is just the measure of how much these rates move on a daily, weekly, or yearly basis, is non-existent, the activity in the market was anemic. And there's no need to hedge interest rates when your interest payments are almost 0%. The 10-year Treasury has gone from 1.5% at the beginning of the year to 3.5% recently. This is a dramatic move. Now that rates are higher and actually moving around, trading of these interest rate products will likely go up substantially. This will be a significant tailwind for BGC's business. If we couple the increased trading and the Phoenix or electronic platform that will drive the business's future profitability, BGC is set to see a rise in revenues and margins expand, a dream combination. The best part is that the company is trading at a low valuation, and earnings will rise soon, making it even cheaper if we look out just a few years. The business is also countercyclical as well. As volatility increases in uncertain markets, trading increases, which benefits BGC's business. This is a good diversifier for your portfolio as well. BGC is a business I followed since 2018. The CEO, Howard Lutnick, has a history of deal making and doing what he set out to do. He has been buying the stock despite already owning a substantial portion of the company. For him to exit his position, the company will one day be sold. I suspect the timeline for this is a few years. One other note on Howard Lutnick. BGC was headquartered in New York City in the World Trade Center, and the firm was located around the 100th floor. The company was crippled after 9/11, and the fact that the company is around today is a testament to Howard and his team. If you listen to him speak, you cannot help but be excited to partner with him. Typically, we talk about similar themes on this call, and you might think, how do Capstone, a mining company, and BGC, a financial broker, have anything in common? We have all seen inflation at the grocery store or other daily needs. To tame and reduce inflation, the Fed has raised rates. So while Capstone is a beneficiary of higher inflation and the subsequent rise in copper prices, the increased volatility and higher rates caused by the Fed's actions to tame inflation benefit BGC. We'd be happy to answer any additional questions you have on BGC or Capstone. This ends our quarterly investor call for today. As a reminder, you can send in questions you'd like answered by our team via email prior to these calls. Thank you.